Okay, so now the main part of this whole chapter, the hardest part, is this bank reconciliation. So as I explained, uh, there's going to be a difference between your accounting books and the bank's records. Okay, why are they different? Now let's talk about the major classes. So timing differences. Okay, so there may be misalignment between when something enters your accounting system and when it hits the bank. Okay, so an example of this is deposits. Okay, so let's say you've collected a bunch of checks from your customers, it's sitting in your office, you've gone to your accounting system and accounted for them, you debited cash, credited accounts payable or whatever it was, or revenue, whatever that journal entry was. You did the journal entry, but you haven't yet gone to the bank and actually deposited the checks. Okay, so that timing difference is going to show a difference between your accounting system balance for cash and your bank account. Okay, so this is a important one, especially if you're collecting checks at the end of the month, right? The bank statement is produced as of the last day of the month, but if you collect checks on like 2 days before, maybe you didn't have time to go to the bank. Okay, so a lot of this will happen towards the end of a period. Okay, when the bank statement cutoff is happening. Another one is checks outstanding, meaning you had a PG&E bill, right? So you wrote a check to PG&E, you went to your accounting system, you debited utility expense, credited cash, but PG&E just is sitting on that check. It's like kind of they have deposits in transit, meaning they have your check, but they haven't deposited it yet. So your accounting system, again, will have that cash credited, but the bank has not yet taken the money out of your bank account. Okay, so this is going to fall again into this category of timing differences. Okay, so this timing differences. Okay, so another one we kind of touched on is the bank statement is a source document for certain things. Okay, so you haven't yet received any other source document for certain transactions. So for example, EFT and direct deposits, you'll have to look at your bank statement to see those transactions. Okay, so it is going to be what triggers you to do the journal entries, looking at your bank statement. Okay, so EFTs and direct deposits, again, the bank fees, right? They're going to list how much they charged you as fees. The interest that you earned, right? That's also going to be on the bank statement. And then whatever NSF checks you thought were deposited, you had accounted for them in the accounting system, but the bank statement is going to show you actually they did not go through. Okay, so again, the bank statement itself as a source document is another reason why we need to reconcile your accounting system and the bank statement. Okay, and it could be that there are errors. Okay, there could just be some mistake that you made. Maybe you debited $100 to cash because you collected some money, but the check was for $1,000 and you just made a typo. Okay, so that would be a case that the correction has to happen in your accounting books because the correct amount was 1,000. You only debited 100. Okay, it could be that the bank made a mistake too, and your accounting system is correct, but the bank made an error. Okay, so errors, it could go either way. You don't know which side is wrong. Depends on the error. And so the goal is to basically make adjustments both to the bank balance and to your accounting system balance and get them to match each other. Okay, because they should be in agreement with each other after these adjustments. Okay, so that's what this bank reconciliation is attempting to do. Okay, so let's go through these and see which ones are which. Okay, so if you had a deposit in transit, okay, is that going to be, is my bank account balance going to be understated or overstated? Okay, yes, it's understated. So that means we'll have to add deposits in transit to the bank balance. Okay, so again, if our bank balance said we have $700 as of the end of July, but we know that we're sitting on $100 of checks that we have not yet deposited, we would have to add that as an adjustment to the $700. We'd have to add it to make the bank balance correct. Okay. What about outstanding checks? Do we add or subtract to our bank balance for the checks that we know are outstanding? Subtract, yes. Because when they are deposited, it's going to reduce our cash balance. So yes, that would be a negative adjustment. So if we knew we had a $50 check outstanding, we'd have to subtract. Okay, what about bank error? We kind of mentioned this, right? What is it? Add or subtract? Both, or it could be either. Okay, it depends. So this depends on the error. Okay, what if you have bank collections? Okay, so now this is kind of like we're talking about what do we do to our accounting books, right? Because the bank collection is obviously going to be reflected here in this $700 because the bank collected that money. But our accounting books have not yet accounted for it. So is that going to be a debit or credit? Really, that should be the question, D or C. Should we debit or credit for the bank collections? Cash. Yeah, debit. So we would debit cash, but what we credit would depend, right? If it was a customer sending us money for an account receivable, we do, debit cash, credit account receivable, right? So we would have to know what the cash was coming in for. Okay. Service charge. Is that a debit or credit? Credit. Okay, good. Interest revenue. Debit. Good. NSF. Check. Everyone good with credit? Credit is right. Because remember, we had initially, let's say someone gave us a check for $100. We would have debited cash $100. But the bank is telling us, hey, that check was bad. Okay. So to correct for that, we'd have to credit cash $100. Okay. And then what about a book error? We just made a mistake in our accounting books. Is it a debit or credit? Depends. Good. Okay, good. So let's just quickly look at the format of this bank reconciliation, and we're going to just pretty much for the rest of the class just practice doing them. Okay. So as you can see, there's two sides, bank and book. What you're doing here is starting with the ending balance that each of these say. Okay, so you can see as of April 30th, as of April 30th. So we're now at the end of the month. We're taking the ending balances and we're going to reconcile them together. Okay, so be very clear about that. This is, I think, a big source of confusion. You're not reconciling the transactions that happen in each. You're just taking the balances that these should be in agreement, right? You would think, theoretically, they're both ending balances of cash. They should be the same, but they're not for all the reasons that we just discussed. Okay, so you're going to start with the ending balances that each of them say. So for the bank balance, this is going to be in your bank statement. For your book balance, this is going to be like your T account, basically. You're going to have all your transactions, whatever. At the end of the month, you would have had a debit balance of $20,850. Now you're going to make your adjustments. So for the bank side, you can see here that you have a deposit in transit, which again, this 9,000 is reflected already in here, right? It was already a debit to cash, but it's not yet reflected in here because it's still in transit. So that's why we're adding it. And then this outstanding check, we're going to subtract this because again, this 2,000 is also in here in this 20,850. It would have been one of these credits. Okay, but in order to now get it kind of reflected in the bank, we're going to do an adjustment. So we get to this balance for the bank. Okay, so now we take everything that's in the bank statement that's not in the accounting system and do the same thing. So we start with the book balance. We have some EFT payments. So again, this information is going to come from the bank statement. This information is going to come from the bank statement. So these are additions. Okay, so we're going to add this. And then we have a bunch of stuff. Service charge. We have an EFT payment. So this is the amount that we paid out. And we have an NSF check. We have these negative adjustments. And we basically should get to the same number. These two should always agree with each other after we've done these adjustments. That's when you know you've reconciled everything. Okay? Another key thing to keep in mind is that this deposit and these outstanding checks, they're already in your accounting system, right? So you don't need to do any journal entry for them because they're already there. You were just including them in the bank balance because they're not reflected in the bank balance. All this stuff on the book side of the reconciliation, they will need a journal entry, right? Because all this stuff, it exists. It's an economic reality of your business, but there's no journal entry yet. Okay, so everything on the book side, this stuff will all require you to actually change your accounting balance by doing journal entries.